All right, there we are. It is March 14th, one day before the Ides of March. And this is the Market Structure Edge live demo and discussion. And I'm Tim Quast. I'm going to cover effectively two things. Only got two things. Brian and I will talk about what's ahead a little bit, but I'm going to talk about my Sentinel-1, nice lead in, Barry Norton, who did good stuff. Exactly. Yes, it is 3.14. Good one, Bob. Pi day. About using market structure to make good decisions with Sentinel-1. And I'll tell you, I'm saying I don't make many mistakes. And it's not because I'm smart, it's because the data are nearly always right. If you use the data and you are careful around options expirations, which commenced today, and you're careful around earnings, you can, most times, there are always exceptions, there are no guarantees, except that none of us gets out of life alive. You can do very well taking small gains, stacking the probabilities in your favor. And I'm going to show you, because we're going to go live with this. I've decided, I talked to our lead engineer last night, we're just going to put these new views on the platform. They're in the test platform now, and I'm going to show them to you. And if everything goes as planned, which it doesn't very often, it'll be live tomorrow. I mean, if we can be. So, our lead engineer is in Barcelona, so we have a 7-hour time difference, which works great, actually. I'm usually meeting with him at about 6 or 6:30 my time in the morning, which is, middle of the day. It's siesta time in Spain. And he hasn't, fortunately, adopted that practice, so it works pretty well. So I'm going to show you those. So my only two things are talk a little bit about Sentinel-1 and the lessons that I can share with you, and then to show you very quickly these things. So when they're up there, and we'll send out a system message, we'll put it in the market desk note so you know, but it's going to be pretty obvious to you. But I want you to know how to use these things. So with that, let me share my desktop. We'll very quickly cover this Sentinel-1 notion. Okay, so there you should see my screen. So here's the story for Sentinel-1. So it shows up back, I can't remember exactly, but we'll look at it and we'll know. You know what we look for in the momentum portfolio? First of all, we screen for liquidity characteristics. We want things that a lot of people could get in and out of easily. Why? Because you want to be able to keep your gains. That you want narrow spreads and a very high probability of completing trades, even trades of significant size. So we begin with that, and we're looking for rising demand that's between 8 and 10, could be at 10, could stay at 10. That's fine, and falling supply that is less than 50%. By the way, supply above 50% does not mean that things won't do well. I could give you lots of examples of stuff that was at 70% supply, and if it declined, the stock still rose. I mean, it's really the divergence that creates this mathematical opportunity. So I bought S about here, and so where should I have left? Well, keep in mind, options are going to expire right in here. How do you know? You can go over here to Using Edge, go out to How It Works, look under Resources, and you'll see the expirations calendars. I know, it's emblazoned in my mind. So I know it's right in here. I'm into options expirations. And why does that increase the risk? Well, the probabilities deteriorate because changes in supply or demand for options can have a very significant effect on price, because they're rights but not obligations. They're implied in the price. And then if I'm not going to use that, well, all of a sudden 10% could come out of the price just like that. So you have to be aware of that risk. And then look at this. Demand fell, supply rose. If that happens, you should leave, particularly during options expirations. And then Palo Alto Networks reported results in here, and they're in the same group. And look what happened to Sentinel-1. Now I still own it. I should have been out, right? I could have put protection in place there too. I don't often, unless I'm particularly concerned. Was I? No. But now what do you do? Because now you have two choices. You either take the loss, which you can do, or you could calculate the probability that you might get most of it back. Well, here's what I did. I immediately said, oh, okay, I'm going to go check something. I wanted to. Profiler is the weakest element of our platform because it was an early thing that we built, and it doesn't address the supply side. It only addresses the demand side, and it's kind of a blunt instrument. But I'm looking at November 2. It's a 90 trading day view. Through March 13th, and I want to know, okay, what happens if it's worst for Sentinel-1? It goes from worst to best, 1 to 10. Is there any probability under those conditions? Well, not much. There are two opportunities. One of them made money, one of them has not and continues. But I could look at this and say, all right, well, if it's a coin flip, I have 16 days for a chance to recover what I have lost on this trade. I don't like these things. This has only happened to me 3 other times because I avoid, if the prudent foresee evil and hide themselves, they can avoid those things. Sometimes imprudence will lead you to situations like this. So I know I've got like 16 days. I have maybe a coin flip of getting back most of what I have lost on this position. So, where are we? You could do the math on that. Okay, so here's, if you count the days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 was yesterday, right? Roughly. So I sold almost all of my position ahead of earnings because I looked at this, but I kept a little bit, so I'm down on that little bit. I thought, well, like Barry Norton, did I look at this math and think it would do well? No, I did look at each of the earnings. We have a lot of tools to look at those things. I looked at this and thought, that's not going to do well. But you never know, because there were times when the data were this bad before and the stock went up 17%. Well, I'm certainly not going to keep most of my exposure. So I got rid of it. And I recovered a lot of what I had lost. This was a fairly good recovery from here to all of my sales were over 28. So I'm close. I'm getting close to where I was, but not good. That's not how you want to deploy capital. So my lesson summarizing is A, beware of options expirations. If you have a position, it will hurt. It has the propensity, doesn't mean it will, to deteriorate your probabilities. Number 2, if demand falls and supply rises and you haven't made money, get out, just leave it and go find something else. Go take a high probability 2% somewhere else. Number 3, beware of earnings, because you don't know what's going to happen. Barry, you were right. You called it, looked at market structure and said, probably because of these conditions, both of these things will be down, doesn't matter what they report. And frankly, Sentinel-1's results were fine. They from a consensus, which is to me, that's the model of the proletariat. It's not worth much because that IP is given away. But they beat on the top and bottom line. I tell public companies, I talk to public companies all the time. That is not what determines the outcome when you report earnings. What determines the outcome is which direction people are betting. And that is much more powerful than the consensus that the sell side gives away. So those are your lessons. When the supply demand equation tells you to leave, leave. Beware of options expirations. It has a propensity to deteriorate your returns. Watch out for earnings, right? Just follow the math. Okay, there's your lesson. I always try to share my good and bad lessons, and all the rest of the time, and I trade a lot. I follow the math and I avoid those things. It works out just fine. Okay, now let me go to this stuff I want to show you. Let's see here. This is in the test environment. So when I say test, it's in our test environment. Some of you probably have access to this who've been with us for quite a long time. But it will be at the top of your dashboard. It will look like this. So it's going to say daily trading ideas. Sorry, I'm going to have to refresh that. So you could just click on that button and it's going to take you to these views. We haven't calibrated this stuff everywhere. And in the test environment, these portfolios are different, so ignore that for the moment. This is for developing code and deploying it and testing it. But it will be at the top of your dashboard. and you can click that, and it will take you to the views that we have developed for momentum and low volatility. And I just want to walk you through these things very quickly. What we have done is to calculate, give you the ability to make good decisions in short periods of time. That's what this particular tool is designed to do. It uses the momentum portfolio and the low volatility portfolio. The only difference in them will be we only keep ones with probability greater than 50%. I mean, if it's a coin flip, why have it in there? So you'll notice, I think in momentum today, if you look at the platform, let me go over here. You know, if you look at momentum today, I want to say it's got, yeah, that's right, 14 in it. So I want to make sure that that's refreshed. I thought there was, yeah, it seems right. So if there are 14 in it, there are 14, there are not going to be 14 over here in this new view because 4 of those, I think it is, didn't have 50% probability. So this has 10 in it, and it's the default sort is volatility. So it's going to give you the one with the most volatility at the top, but you can sort it by anything. So I'm going to sort by probability. Now we have toast. In the trailing data, 100% of the time, when these conditions existed, keep in mind, options are expiring, that you would have a probability of making 2% and it would come true. Doesn't mean it will this time. So, you know, past performance, no guarantee of future outcome. This is not advice, it's math. So there's no way for us to calculate future outcomes without using past outcomes. And past outcomes, you just never know, right? But what it's telling us is that there's an entry range. So it's between 24.66 and 25.38 versus a last close of 25.09. You have 100% probability in the trailing data of producing 2%. Exiting up 2% from here would be 25.16. Up 2% from here would be 25.88. And you might get a lot more. Sometimes you get more. I'm just saying we're calculating get 2%. And you want to do that in 1 to 5 days. So we've made this pretty clear. We've said, okay, you know, we've screened for criteria. The probability is based on a gain in 1 to 5 days. I can't show you exactly. You just have to see those notes. We've done, I think, a pretty good job of explaining how to use these data. And then I'm going to show you all the way through here in just a little bit. But then low volatility will do the same thing. It will be ranked by volatility. And so SRE is at the top of the list. If you wanted to rank them by probability, you know, PFGC is at the top. There are 4 of them that in the trailing data, 100% of the time. So, sorry, I got my mother-in-law is calling on Alexa at the moment in the background. So this math is designed to give you actions and a time frame and give you a high probability. That's what it's designed to do. Then you could just look at them by probabilities. So it's either table or probabilities. So if I looked at this and I went, let's go look at LYB. This is the data, and you're going to be very familiar with these views. So let me refresh that. In the test environment, there are some issues like this because we don't have all the accelerators around this data. It's a cheap environment. So going back to LYB, I just want to show you this that the supply-demand equation now includes some additional data so that you could look at this and see high-low close. It looks kind of messy, but it's meant to show you that prices move a lot. And the movement up accelerates when demand and supply deteriorate or diverge. And that's what we're after. So, and notice that up here says high, low, close. You can see those in a candlestick, but we wanted to be able to show you that that's where the probability of the return arises. And then it just spells it out for you. So today you were looking for in LYB an entry range in here, and either today or in the next 5 days, we want to exit with a 1% gain. Again, all you're doing is trying to make sure that everything you do produces a return and protects you from losses. And so is it perfect? No, but it's pretty darn good. I know of nothing else like it, where we're being very, what do I want to say? I don't want to say precise, but very disciplined in the objective, the entry range, the exit range, the time frame. And so I think it's going to be helpful. We added broad sentiment in here. It looks the same. I mean, it's just going to be in here so that you always have that comparative and you know where you are. So questions, comments, observations, I'm going to hand it over to Brian here, but that's the introduction. And I want your feedback. We're going to put it out there, and then, tq@marketstructureedge.com is my email. Drop me a note and say, hey, it's missing this, or I found this thing, or we noted this. We've vetted it, but look, there are things. I'm of the agile mentality in software development. When we're pretty close, I feel good about the underlying architecture, then we get it out there and get some feedback. Okay, and then Brian, it's your turn.
Thanks, Tim. One question you might want to take from Joe, just in regards to the test environment.
Let's see. And Joe, to your question about other groups, yes, that certainly is our objective. One could debate that question, but yeah, I mean, it would be great to have the probability under any condition, but then does it lose its usefulness at some point? Maybe. You want to make sure that you're putting high probability in front of everybody, but certainly we would have that capability to do that. Jeff, yeah, I would say so, but keep in mind, Jeff, so Jeff says toast price is currently less than the low entry. Do you consider that to be an outstanding entry point, or would you make it a scratch? The only qualifier tomorrow, is a quadruple which I don't even know if there are a full 4 single stock options futures, index options and futures, thus the 4 anymore, but there's all of that. S&P rebalances, those spill on either side. So those are things that are going to be challenges. But otherwise, I would say yes. I mean, if we weren't in options expirations, to me, that'd be a very good opportunity, and they weren't reporting results. So just keep that in mind. Would I do it here? All of my mistakes, all 4, have occurred when I A, ignored the supply-demand change, or B, traded during options expirations or earnings. That's it. Daily trade would be available. It should be, Michael, out there tomorrow. It depends on whether that we feel comfortable that it can be deployed to production, but it should be. Okay, I didn't leave you a lot of time there, Brian. I'm sorry about that.
Oh, you are fine. Thank you. Good to see everyone again. I always enjoy walking through this. I wanted to take a little bit of a macro look here at the beginning. I've started to see some articles about the Magnificent Seven. Maybe the Magnificent Seven are going away. And you start to see some of these components. And you can go to the State Street website, and you've seen me do this exercise a couple of times. What I wanted to show you just recently, and I just dropped, I think it's the top 35 names in here, which represent 51% of the SPY. You can see over a 3-week time frame here, we're starting to see some of the weightings go down, and I've highlighted specifically the Magnificent Seven over here on the right, and of course there's 8 when you look at the alphabet and voting and non-voting. But you can see that weightings are going down in 5 of them, weightings are going up in 3 of them. And if you back this look up, and I forgot to get this date, but this would have been about 6 or 7 weeks ago. If you look at the weightings then compared to now, they're going down a little bit. Microsoft has gone down. Apple's gone down by about 1 and 1.25 or so. Nvidia, of course, is going up. It used to be 4%. That's north of 5 now. Amazon and Meta going up a little bit. But part of what you'll see in the press, is this a good thing or not? If the Magnificent Seven is truly going away, it's certainly up for debate. But if you look at the performance here, and I have a 1-month chart, Nvidia's up here on top. S&P 500 is right here in the middle. So everything's kind of with the Magnificent Seven coming under a little bit of pressure during the last month. It's kind of taken away some of the oomph from the market. And you can see that a little bit with what's happened with broad market sentiment. And Tim talked about this, I believe, yesterday. I talked about it in today's market desk note. But, this is it's a holding pattern. We're circling the airport, waiting to figure out what happens next. And if we look at what happened from NVIDIA, this was earnings for NVIDIA right here. From this point going forward, I believe that was 15 trading days, if I remember correctly, 11 basis points on average every day. So it's been a grinded higher market environment. And Tim and I will talk about this a little bit in the what's next for the market. But we're at a potential inflection point right now. And I think you could make the argument that with the Magnificent Seven suffering a little bit, I think the broad market has suffered as well. And if you look at the total components right now, it's about 30% of the SPY. If the Magnificent Seven are floundering, by definition, the whole market's just going to have a difficult time moving forward. So I guess it's, be careful what you wish for. If the rally does broaden out a little bit, better for some of the other components, but it remains a very top heavy, SPY. So that was part of the update I wanted to give there. I also wanted to just give an update in terms of how I approach trading, what I've been doing recently. And I think I mentioned this in today's market desk note. I set up portfolios, and I should rename these. These are very old, but this is my low volatility portfolio. I'll just drop all those names in there. This is my momentum portfolio. I'll drop all those names in there. And what I'll do, I'll be working on other things during the course of the day. And I'll just periodically, every 20, 30 minutes, just go and check some of those names. And I've had access to what we'll hopefully be seeing tomorrow. And for the last 4 or 5 days, I've been dropping names with 90% or greater potential. And I will choose to, try to trade those first if I have the opportunity, because the probabilities are higher in those names. What I've also been doing a lot, and I've traded 10 names over the course of the last week, just with intraday volatility. And I've made money on 8 of those names, and not bragging. I'm just following the math, thankfully, following what has been a good system. And I don't have to do anything special. I just have to follow the rules there. One area that I will do, and I just have a special portfolio that I just dropped the Magnificent Seven in. Since these names are so liquid, I will typically go and just check these every day for supply demand characteristics. So if you look at, take for example, Apple right now, sentiment low 1.8. But if you look at what Apple is doing, kind of a little bit of divergence. Demand is just starting to sneak higher. Short volumes are still, relatively low. I actually took a flyer a couple of days ago and said, I'll try Apple for more of a longer term view, seeing if it will bounce off of oversold conditions. I'll see if that will work or not. But that was part of the reason that I went into the trade. I knew that short volumes were very low, and I knew it was going to bounce at some point from one. That's a longer term play, if you're going to buy something that's oversold like that. But if you look at some of the other names, Microsoft today has good supply demand characteristics, neutral sentiment, very low short volumes. I made money a couple of days ago in Microsoft just trading intraday volatility. I know that, if we get a little bit of weakness in the name, I can pick that up, because that's a great setup. I actually traded NVIDIA earlier today. And I was looking, once again this morning, I was looking at its supply demand. characteristics and good demand. Short volume's just starting to rise a little bit, but that's still very good in terms of overall divergence. I think I bought NVIDIA today when it was down 4% and, sold it when it was 3.5 or whatever. I wasn't looking to make that much. I was just looking to capture part of that intraday volatility. Why did I buy it when it was down 4%? Well, look at the normal intraday volatility, 6.2%. It's down more than half of that intraday volatility. Good demand, good supply. I took a flyer. It's in the middle of expirations, but I was like, that's a pretty good, idea for a trade for today itself. And Tim, I think I'll start the look ahead, and then
Yep.
I can switch back to you in terms of screen sharing. If we look at what's next, I had mentioned it earlier. We've been in a grind it higher environment. Where do we go from here? It's a great question. We still have demand that is healthy. 6.1 short volumes just starting to sneak higher, but they're still controlled, relative to where we have been. It's still pretty good from an overall perspective. If we do get strategies that start to change, we'll often see them, and Tim might be able to speak into this a little bit better than me, but sometimes we'll see it tomorrow. A lot of times we'll see it on Monday. Monday itself, the focus will shift to the April series, and that's a logical time frame, to see a shift in strategies. In terms of where future gains might come from, two thoughts here that I was looking at. One would be potentially the mega caps. We still look pretty good there. Demand 5.8, still very healthy. Short volumes at about 45%, market average north of 49. So we're still, very good from a mega cap perspective. Still very good from the triple Qs. You look at sentiment 5.7, short volumes at about 47%. So mega caps, triple Qs, both better from a short volume perspective than the broad market at large. So with that, I'll stop my sharing, and if Tim has anything to share, feel free to.
I'm not sure I can add much of value to that. That was a pretty good assessment. The question that I have, and it doesn't really show up in the data. If you look at to me, the best thing still to look at is you look at broad sentiment. The S&P 500 is 87% of market cap. I think it's good to have that mega cap portfolio. That's the triple Q. That's a good idea, Brian. Because that's where the market cap is. If you want to watch those things, because the money that causes the market to move is in those things. So to finish my thought about this and why Monday could be important, I'm not saying it will be. This options expirations period is split into 2 different weeks, Thursday, Friday this week. So today, index options expire. Those are used heavily by index funds. I've mentioned this before, so I repeat myself, not because I'm losing so far as I know, I'm not losing my mind yet. It could happen at any moment. But for anybody who is joining and hasn't heard it before, but Brian Wilson used to work with this fellow. He was on our client services team at the other business, supporting public companies, and he used to be a Mellon portfolio manager, and his whole job was to buy and sell baskets of options and futures to true up index tracking. Is a lot more efficient and flexible than, say, I need 0.7% of my portfolio needs to be in X, Y, and Z. So am I going to go out there and buy all those stocks? No. You just go to a bank and you get a futures contract or something like that. That's permissible under the Investment Company Act of 1940 for up to 10% of the assets. And so it happens a lot. The market is very difficult to get in and out of. So what happens today is a tell about that. It's not whatever the talking heads are talking about. And I think that it's been pretty volatile. Not bad. I mean, is the S&P 500 is down 25 points, but the amount of volatility today from pre-market till now is pretty amazing. And so, what's that tell us? Well, to me, it suggests that the exposure to equities may have decreased some. Tomorrow, all these baskets of options and futures that people use for a lot of purposes, risk management, leverage, speculation, substitution, all of that will either expire, roll, or renew. And then Monday, a new series trades. Well, will the fact that all the data keep pointing to a, quote unquote, higher for longer, I just get so tired of all that stuff. Our market should not be run on central bank interest rates, but it's an issue. Will that mean that people reduce their exposure to equities come Monday when all that new series trades? I don't know, but it's a possibility. And then we just watch the data. If I look at broad set, and I'll finish here. One last look at this. If you look at broad sentiment, and Brian's done a really good job with this. We used to say, I'm getting updates pushed, and so I knew it was going to boot me out. If you look at broad sentiment, an extended period like we've had, so is unusual, but it also tends to follow periods of great momentum. We say that momentum has a very long contrail. What I mean by that is if the market slams above the red line abruptly, the carry through can last a long time. It's very much like having a very powerful rocket engine launch you. Now, until gravity begins to have an effect and pulls you back toward Earth, there can be a significant and extended period of time. I'm flat telling you that is developing. It is. I don't know when exactly this will break down, but we had this massive rocket engine launch of sentiment back here when the Fed reset policy. When it said, we're not going to tighten, now we're looking at, well, when do we begin cutting? Has that changed? Well, it doesn't matter. What happened is everybody changed allocations. It repriced derivatives. It repriced equities and bonds. And boom, we ran straight from that. But that ended. It really ended in December. This is the contrail. And notice that we can't even get over 6. We ticked up to 6.1. I don't know if that holds, but it tells us that the fuel has been consumed. Now, will it collapse? I don't think so, but this could change very abruptly, as it did here. The changes in these things can happen very abruptly. And so I look at it and say, no one knows. I don't know if we're going to have another surge, but another surge when the market's already at 6.0, I don't know if that's ever happened. And we started developing this measure in 2010 when the modified uptick rule that created this data set down here went into effect. So we have been tracking this data since it was available. So we have a lot of experience with this data. And I don't know that that has ever happened. So therefore, the probability is it doesn't, right? It doesn't. So we're all going to have to watch that and realize that this great momentum run we've had from here to here probably isn't going to be around. And that may mean that we take smaller gains. The beautiful thing is edge works no matter what's going on. The opportunities may be more or less, but the principles are always there because the rules have not changed. And they're unlikely to change for the foreseeable future because the SEC has a lot of pride of ownership in the structure that we've got. Oh, that's, I think, where I will conclude with for today. Any thoughts, comments, questions?
So, Brian, I think your idea of using Yahoo Finance and dropping the tickers in when you can print the spreadsheet, I do the same thing, and it's a phenomenal tool. Yeah, you got to put some comments in to load the tickers. It's not that bad. But once you have it down, I do the same thing. I just map out the volatility and, the market opens. Once it gets settled and you kind of see the trend for the day, then you can go in and look at the portfolio and see what's working in your favor. And it usually works out pretty good.
It does. And you generally know in your low volatility portfolio, anything let's say if a name is down by 1.2, 1.3%, that's usually going to be half of its intraday volatility. So you know right away. It's like, okay, that's the names I want to look at here. And momentum, you're generally looking for names that are down 2 to 3%, something like that. And they stand out pretty fast. Yeah.
Yep.
That's good stuff, you guys. Yeah. I mean, if you can be right 8 out of 10 times, you will be very wealthy. I think I shared that a portfolio manager who was very successful told me, I'm aiming to be right 51% of the time. That's all it takes. So if you can be right 8 out of 10 times, you're on the right path. Just watch those potholes. All right, you guys. Good to see everybody. Thank you. Thanks for the input too, Barry. Always appreciate that. And we'll do it again next Thursday. Look forward to seeing you there.